Wall Street has always had a reputation for power, money, and ambition. But after the 2007 and 2008 financial crisis, many people began to ask a deeper question. How much of Wall Street's success was built on real skill, and how much was built on unfair advantage? That question sits at the center of Black Edge by Sheelah Kolhatkar. The book tells the story of Steve Cohen, one of the most successful and controversial investors on Wall Street. To the outside world, Cohen looked almost superhuman. He seemed to know exactly when to buy, when to sell, and which companies were about to rise or fall. Again and again, his firm made enormous profits from perfectly timed trades. But according to Kolhatkar's investigation, Cohen's success was not just the result of talent, instinct, or luck. It was built around something called Black Edge. In the world of hedge funds, an edge means an advantage. A legal edge might come from better research, better analysis, or faster decision-making. But a black edge is different. It means illegal inside information, confidential information about a company that ordinary investors do not have. And if a trader has that information before the public, they can make huge profits before everyone else even knows what is happening. This is the story of how Steve Cohen built SAC Capital Advisors, one of the most powerful hedge funds in the world, how that firm became deeply connected to insider trading, and how U.S. authorities spent years trying to bring Cohen down. Some of Cohen's traders went to prison. SAC paid record fines. But Cohen himself was never convicted, and he remained one of the richest men in finance. To understand how this happened, we first need to go back to the beginning, before the investigations, before the billions, and before SAC became one of the most feared names on Wall Street. In 2008, while the world was collapsing into financial crisis, U.S. federal agents were investigating another Wall Street titan, Rajaratnam. Rajaratnam was using illegal inside information to make trades and generate large profits. As investigators interviewed people and followed the evidence, one name kept appearing again and again. That name was Steve Cohen. At first, Rajaratnam seemed like a major target. But investigators soon began to wonder whether an even bigger case was waiting behind him. Rajaratnam, as powerful as he was, may have been only a smaller part of a much larger world of insider trading. So who was Steve Cohen? Cohen was born in 1956 and grew up in a middle-class family on Long Island, New York. From an early age, he was fascinated by markets and money. As a student at the Wharton School at the University of Pennsylvania, he read the Wall Street Journal every morning and followed the stock market closely. He was also a talented poker player. That detail matters because poker and trading have something in common. Both involve risk, timing, psychology, and the ability to make quick decisions under uncertainty. Cohen made money playing poker with other students, and this early experience helped build his confidence as a risk-taker. In 1978, at just 21 years old, Cohen joined Gruntle & Company, a New York brokerage firm. His talent showed almost immediately. In one afternoon, he made $4,000, which was a huge amount of money in 1978. Over time, he became extremely successful, reportedly making $5 million to $10 million a year. But early success came with early suspicion. In 1985, the Securities and Exchange Commission, or SEC, investigated Cohen's transactions. Cohen had received inside information from a friend about an upcoming takeover of RCA by General Electric. He invested heavily in RCA shares and made around $20 million when the takeover was announced. The criminal case was eventually dropped. But the incident raised an important question about Cohen's trading style. Was he simply brilliant at reading markets? Or was he benefiting from information that other investors did not have? That question would follow him for decades. And as Cohen became richer and more powerful, the methods behind his success became more aggressive, more organized, and more suspicious. Within about 14 years, Steve Cohen went from being a junior trader to a respected and feared figure on Wall Street. By the early 1990s, he no longer wanted to remain inside Gruntle. He wanted his own firm, his own structure, and his own way of making money. So in 1992, he founded SAC Capital Advisors. The name came from his own initials, Stephen A. Cohen. SAC was a hedge fund. It invested money gathered from wealthy individuals and institutions, and it aimed to produce very high returns. Cohen started with $23 million and only 9 employees. The growth was explosive. Within 3 years, SAC had grown to around $100 million. After that, the firm doubled almost every year. By 1999, SAC had more than $1 billion in assets. Cohen was becoming extraordinarily rich. But the big question was, how did SAC make so much money so quickly? Cohen's strategy focused on short-term movements in stock prices. Every day, SAC gathered information about the market, bought large amounts of shares, and sold them when prices moved in the right direction. This required speed, pressure, and constant information flow. At first, the strategy depended heavily on Cohen's trading instincts. But by the late 1990s, short-term trading was becoming harder. Markets were more competitive. Information moved faster. Easy profits were disappearing. So Cohen pushed SAC toward a more intense model. He began hiring traders with what the firm called a fundamental edge. In normal investing, a fundamental edge might mean deep knowledge of a company or industry. But at SAC, the search for edge went further. The firm wanted traders with strong industry contacts, personal relationships, and access to valuable intelligence. If a potential hire knew people inside an industry, that was valuable. If the person lived near an executive or had a personal connection to someone important, that was even better. Every possible relationship could become useful. SAC wanted information before the market had it. And that is where the line between legal research and illegal inside information became dangerously thin. The firm built a culture where traders were expected to find information that could move stocks. They needed to know what would happen before official announcements. They needed to anticipate earnings results, drug trial outcomes, mergers, and business problems. In that culture, information became the most valuable currency. The more SAC grew, the more its profits looked almost unbelievable. Cohen's personal fortune rose to nearly $10 billion by the mid-2000s. He bought expensive artwork and lived like one of the richest men in the world. But to many observers, SAC's performance looked too good to be true. And eventually, the accusations became impossible to ignore. By 2006, SAC Capital was no longer just admired. It was also feared and suspected. That year, 2 Canadian companies, BioVail, a drug manufacturer, and Fairfax, an insurance company, accused SAC of manipulating their stock prices. The accusation was serious. They claimed that SAC had spread false and negative reports about their business performance and business practices. These reports damaged investor confidence and caused the company's stock prices to fall. That was useful for SAC because traders could profit by betting against those companies. In the case of Fairfax, employees claimed that they received strange nighttime phone calls from anonymous voices saying Fairfax was fraudulent. Anonymous websites also appeared, comparing Fairfax to Enron, the infamous company that collapsed after massive fraud. The accusations against Fairfax were unfounded, but they still created pressure around the company's stock. Regulators noticed. The SEC and the FBI began paying closer attention. At the same time, SAC's internal culture continued pushing traders to obtain valuable information before the public did. SAC's model focused on short-term stock price movements, especially after specific events such as earnings announcements or drug trial results. Managers pushed traders to talk to contacts, build relationships, and get information before official news was released. One favored method was the use of expert networks, such as Gerson-Lehrman Group. These networks connected investors with industry experts, including executives and specialists. In theory, these consultations were legal. Experts were not supposed to reveal confidential inside information. But in practice, they could drop hints. They could guide traders toward conclusions. They could reveal enough to help investors guess what was coming. And that information could flow back to SAC traders. Once traders had valuable hints, they could use them to make trades before the broader market understood what was happening. This was the world SAC operated in, a world where every conversation, every relationship, every private hint, and every personal connection could become a trading advantage. But the most famous and damaging example would come from a medical trial involving Alzheimer's disease. Alzheimer's disease affects millions of people. In the United States alone, nearly 5 million people have suffered from it. The disease causes severe memory loss, and for years, effective treatment remained extremely difficult to find. So when pharmaceutical companies work on a possible Alzheimer's treatment, Wall Street pays close attention. A successful drug could be worth enormous amounts of money. In the 2000s, two pharmaceutical companies, Elon and Wyeth, were developing an Alzheimer's drug called bapineuzumab, often shortened to BAPI. At SAC, a trader named Matthew Martoma became deeply interested in the drug. Martoma built a relationship with Dr. Sid Gilman, a respected doctor involved in the BAPI development process. Gilman served as chair of Elon's Safety Monitoring Committee, which meant he had access to confidential information about the drug trials. Gilman had signed a confidentiality agreement. He was not supposed to share trial information, but Martoma was persuasive. The two spent hours on the phone. Over time, Martoma pushed Gilman into discussing confidential details about the BAPI trials. At first, the information made Martoma optimistic. He believed BAPI might succeed. Based on this belief, Cohen and Martoma built a huge position in Elon and Wyeth stocks, worth more than $700 million. The final BAPI trial results were scheduled to be released on July 28, 2008, at the International Conference on Alzheimer's Disease in Chicago. Gilman was one of the few people who knew the results in advance, and he showed them to Martoma. The results were disappointing. BAPI was not the broad breakthrough investors had hoped for. It appeared useful only for a small number of patients, which made it much less attractive as an investment opportunity. Martoma understood what this meant. On July 20th, before the public announcement, he called Cohen. They agreed to quietly sell off their Elon and Wyeth shares. But they did not only sell. They also began shorting the stocks. Shorting means betting that a stock price will fall. A trader sells borrowed shares before the price drops, then buys them back later at a lower price, keeping the difference as profit. By the time the BAPI results were publicly released, Elon and Wyeth share prices had fallen sharply. SAC avoided massive losses and made enormous profits. Martoma and Cohen's trades produced around $276 million. This became one of the clearest examples of what investigators believed SAC was doing, using confidential information before the public had access to it, then trading aggressively on that advantage. For years, hedge funds had operated in a gray and poorly monitored world. But after the financial crisis, regulators began paying closer attention, and SAC became one of their biggest targets. By the late 2000s, insider trading was not rare on Wall Street. Hedge funds, unlike large banks, had often operated with less scrutiny. They were newer, more secretive, and harder for regulators to monitor. Many people in the industry treated insider information as part of the game. But after the financial crisis, the mood changed. Authorities wanted to show that they could still enforce the law. They wanted to prove that Wall Street's most powerful players were not untouchable. In 2009, the FBI began secretly investigating SAC's trading practices. Their real target was Steve Cohen. But Cohen was difficult to reach directly. He had built layers of protection around himself. So investigators used a step-by-step strategy. They looked for junior analysts and traders who had engaged in suspicious trades. Then they tried to pressure those people into giving evidence against higher-ranking managers. The hope was that the evidence would eventually lead all the way to Cohen. One of their early targets was Jonathan Hollander, a former junior analyst at SAC. Hollander had traded stock in Albertsons, a supermarket chain. A friend had leaked information to him about a coming takeover. This gave investigators a starting point. But Cohen had created a system that made it harder to prove direct involvement. He asked analysts to rate potential trades on a scale from 0 to 10. This allowed him to receive trading ideas without necessarily being directly told that the information was illegal. It created distance. It gave him a layer of deniability. Around the same time, the SEC was also investigating SAC's trades in Elon and Wyeth before the BAPI results were announced. SAC's timing looked too perfect to be innocent. Then, on November 19, 2010, the Wall Street Journal published an article revealing that the FBI and SEC were investigating insider trading at hedge funds. The article created panic. Traders had been warned that authorities were watching. Some quickly began destroying hard drives and evidence. The investigation's cover had been blown. From that point on, the authorities had to move faster. If they waited too long, evidence could disappear, witnesses could prepare defenses, and the trail could go cold. Soon, the focus narrowed toward two important figures, Matthew Martoma and Dr. Sidney Gilman. After the investigation became public, authorities needed a breakthrough. In May 2011, they found one. The SEC had already suspected that Dr. Sidney Gilman might be the source of the leaked Boppy trial information, but they still needed to identify his contact inside SAC. So they subpoenaed Gilman's phone records. In those records, they found a mysterious phone number. That number belonged to Matthew Martoma, a portfolio manager at SAC. The investigators also discovered something even more important. Martoma had contacted Steve Cohen shortly before SAC sold its Elon and Wyeth shares. The pieces were beginning to connect. And when investigators dug deeper into Martoma, they found more troubling details. Matthew Martoma was not his original name. He had previously been known as Ajay Thomas. Under that name, he had attended Harvard Law School. But during his second year, he struggled with coursework and tried to secure a prestigious legal clerkship by forging grades on his transcript. After that scandal, he left Harvard and eventually changed his name. To investigators, this history mattered because it suggested a pattern of dishonesty and pressure-driven behavior. Soon, FBI agents confronted both Martoma and Gilman at their homes. They explained their suspicions of insider trading and tried to get them to cooperate. But the real goal was still Cohen. Investigators believed Martoma and Gilman could help them reach him. If either man cooperated and gave evidence that Cohen knowingly participated in insider trading, authorities might finally be able to bring down the most wanted man on Wall Street. But cooperation would not come easily. When FBI agents first confronted Matthew Martoma in 2011, they had strong suspicions, but not enough evidence to arrest him. They questioned him. They tried to pressure him. They hoped he would cooperate. But at that stage, the case was still incomplete. A year later, the situation changed. In late 2012, FBI agents returned to Martoma's home. This time, they were not there just to ask questions. They arrested him. The early interrogations had not gone smoothly for investigators. When Dr. Gilman was asked about the scientific details of the Boppy trials, he could remember them clearly. But when asked about his relationship with Martoma, he claimed he could not remember details. Martoma, meanwhile, invoked the Fifth Amendment, refusing to answer questions that might incriminate him. This was important because Martoma faced a possible prison sentence of up to 10 years. If he had cooperated and implicated Cohen, he might have reduced his sentence. But he did not. Investigators wondered why. Maybe Cohen was paying his legal costs. Maybe Martoma feared retaliation. Maybe he had other reasons to stay silent. The truth remains unclear. In August 2012, Gilman finally agreed to cooperate. He admitted that he had given Martoma inside information about the Boppy trial results. That gave the FBI enough evidence to arrest Martoma. But it still did not give them enough to charge Cohen directly. Cohen understood the danger. In the spring of 2013, SAC agreed to pay more than $600 million to settle insider trading cases. From Cohen's perspective, this may have seemed like the easiest solution. If legal problems could be solved by writing a check, then perhaps the firm could survive. But the case was not over. The SEC still wanted to charge Cohen himself. Then another piece of evidence appeared, an email connected to a different insider trading case involving Dell. In the summer of 2008, SAC trader Mike Steinberg received inside information about Dell's disappointing business results before they were public. Steinberg used that information to bet that Dell's stock price would drop. When it did, he made around $1.4 million. The SEC obtained an email Steinberg had sent to Cohen about the information. This looked potentially damaging. Cohen had received the email and sold Dell shares soon afterward. But Cohen's lawyers had an effective defense. They argued that Cohen received around 1,000 emails a day and read only about 10% of them. Therefore, it could not be proven that he had actually read the incriminating email. Because prosecutors could not clearly prove that Cohen acted on the email, convicting him became extremely difficult. The SEC eventually dropped that line of inquiry. Still, SAC paid another record fine, around $1.2 billion in July 2013, to settle the case. Then, in the fall of 2014, Matthew Martoma was sentenced to 9 years in prison. He was repeatedly given chances to cooperate and testify against Cohen, which could have reduced his sentence significantly. But he revealed nothing. Cohen himself was never convicted of any criminal charges. And perhaps the most frustrating part for investigators was what happened next. In April 2014, Cohen rebranded SAC Capital Advisors as .72 Asset Management and continued operating. Despite years of investigation, U.S. authorities could not secure a criminal conviction against him. Cohen remained extremely rich. In 2014, he earned around $2.5 billion. The firm paid record fines. Some traders went to prison. The SAC name was damaged. But Steve Cohen walked away. The main message of Black Edge is that Steve Cohen was a gifted investor, but his firm, SAC Capital Advisors, was built around a culture that repeatedly crossed the line into illegal insider trading. Cohen's talent was real. From a young age, he showed unusual skill with risk, timing, and markets. He became successful quickly, first at Gruntle and later through SAC Capital. But the book argues that talent alone does not explain SAC's extraordinary profits. SAC operated in a world where information was everything. Traders were pushed to find a fundamental edge, but in practice, this often meant searching for confidential information before it became public. The firm built networks of contacts, used expert networks, pressured analysts, and rewarded traders who could deliver valuable intelligence. In this environment, the line between legal research and illegal insider trading became blurred and often crossed. The Boppy case became one of the clearest examples. Matthew Martoma obtained confidential Alzheimer's drug trial results from Dr. Sidney Gilman and used that information to help SAC avoid losses and generate massive profits. U.S. authorities spent years trying to prove that Steve Cohen himself knowingly participated in insider trading. They investigated junior analysts, traders, emails, phone records, and suspicious trades. They brought cases against SAC employees. They secured cooperation from Gilman. They convicted Martoma. But they never convicted Cohen. SAC paid enormous fines, including settlements of more than $600 million and later $1.2 billion. Martoma received a 9-year prison sentence. Other SAC-related figures faced legal consequences. Yet Cohen remained free, rebranded his firm as .72, and continued making billions. The deeper lesson of the book is uncomfortable. Wall Street does not always punish wrongdoing equally. The people closest to the illegal acts may go to prison, while the most powerful figures can sometimes remain protected by distance, legal complexity, and carefully designed systems of deniability. Black Edge is not only a story about one hedge fund. It is a story about power, money, information, and accountability. It asks a difficult question. If someone builds a fortune from a system that rewards illegal information, but prosecutors cannot prove exactly what he knew and when he knew it, has justice really been served? And that is why Steve Cohen's story remains one of the most controversial stories in modern finance.